Henry, you want to give us a 3, 4, 5 minute intro on this before we kind of open up numbers, where you found it and where you are in the process and all that good stuff?
Yeah. So it's a distribution business. It's a recurring distribution business route space. I uh, I can't remember where I found it, but it's a brokered deal. I like it because, well, let me start with the high level. It's about a little over 700K in EBITDA slash SDE after adjustments. I like it because it's route space. There's a compliance component. It's recurring, and they have hundreds of clients. So they're the client base is pretty large. So you can the risk of client churn, one client churning is you would think would be low, but as I learn more about the deal, which I'll share as Paul drives the call, I'll reveal more about some of the nuances of it that make it good and bad. Uh, and then let's see, what else can I share? I won't spill all the beans because there's some in it that Paul is going to walk us through, and it's not going to be obvious what's going on, but I'll chime in so folks can get a sense for like what to watch out for. What else can I say? The other thing I liked about the business is it's been around for a long time. It's probably older than most people on the call, so that's also attractive. Again, a routes based business that's older than me, and yeah, so that's the backstory. Any folks have any other questions before he gets into it?
Okay, can you guys see that?
Yep.
Yeah.
Cool.
All right. Come on, give me a little bit bigger. All right. So we, in essence, got a 2 year P&L here. Do you know what year to date this is through, Henry? It says period to date. Is this last year? All of last year? What is this?
That's all of last year.
Okay. So we got
Yeah, 24 and 25 we're looking at
we got
basically.
right here in the year to date. So that's 25 and this would be 24 here, right?
Correct.
Okay. So you guys just start spitting out shit when you guys start seeing them. So we have a 20% decrease in sales year over year. Do you know what's going on there?
They lost a big client because it was unprofitable.
They said it was unprofitable.
It was
So
well,
did they kick him to the curb?
that's what they said. They said that they kicked this client to the curb. Yeah.
Interesting. Okay. So the margin should go way up then, right? If that's the truth. Does everybody understand that? So they just lost a customer that was doing $2 million a year in revenue, and they said they weren't profitable. So that means my margin should have gone way up, right? So gross profit, let's see if that holds true.
We did go up.
So that's 29% last year. So our margin should go way up this year, which it kind of looks like it did.
Yeah.
2317 divided by 7576. 31%. Not a whole bunch. Went from 29 to 31%. The margins went up a little bit. But that's margins. They could have laid off a bunch of people and all that sort of stuff too regarding that account. Okay, so let's just keep going down revenue here. I can't this won't let me highlight anything.
Yeah, they didn't give me like a spreadsheet. They just gave me a PDF
Okay.
this in it. I was annoying. I would have given you a spreadsheet if I had it.
So purchases are also down about 21%. Again, the overall gross profit went from 29 to 31, so that's actually a little bit better. Okay. So you can see that their wages went down from 938 to 952. So they didn't have enough as much work, so they let people go. Insurance, medical, this is just for owners. So that's an add back, I'm assuming, all of that, 69 and the 59.
That's a lot for insurance, by the way. I thought.
Yeah.
Yeah, they could have all, well, it says medical. So I don't know what's rolling in there.
It says owners medical.
It
Mhm.
does say owners right there,
Yeah, so I
line
was like,
503.
that's a lot.
It is a lot. But it could be titled wrong. There could be other insurance in there. There could be car insurance. It could be life insurance. It could be all sorts of stuff in there.
Fair. Okay.
By the way, let's talk about life insurance real quick. So I like to be educational while we're doing this here. So when you have Uncle Sam likes to get paid taxes in one form or fashion. Okay. And what I mean by that, if you provide life insurance on yourself, and let's say you had a partner in a cross sell situation, you have insurance on each other's lives. So if the one dies, you use that insurance to buy the other partner out, right? So if your business is worth 20 million, your partner dies, you don't know, most people don't have $10 million of cash sitting around. So they buy $10 million worth of life insurance on the other partner's life. And I would be the beneficiary. I take that and I buy his estate out with that cash. Okay. Does everybody understand that? Super important to do if you got partners. Okay. And by the way, if you get an SBA note, the SBA now, they didn't used to do this, but now will make you get a life insurance policy with the bank as the beneficiary. So if you die and you have $1 million loan, they're going to make you get a $1 million life insurance policy that the bank is the beneficiary. Okay. So make sure it's a small expense, but make sure you're adding that as an expense to your pro forma when you're buying a company. Okay. So back to my life insurance deal. Okay. So Uncle Sam wants his taxes. So if I take that life insurance, let's say that life insurance expense for me and my partner is $10,000 a year. I can either record it in one of two ways, above the line or below the line. And what I mean by that is above the line is tax deductible. So it's just going to show right up here. I'll throw it in line 503, right? Life insurance, 10 grand. So therefore, I just took that as a tax deduction. Therefore, I did not pay taxes on it. So when one of us dies and I receive a $10 million benefit, guess what? All of that is 100% income. I took a $10,000 reduction, saved $3,000 of taxes. I received $10 million of benefit upon that death, but because I took it as a tax deduction before, now I owe $3 or $4 million in taxes. Doesn't make sense. Okay. So make sure when you're doing cross collaterals, cross purchases, that sort of stuff for life insurance, make sure it's below the line. Therefore, you are not taking it as a tax deduction. Super, 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 super important that everybody understands that. Okay. All right, let's move forward. I always just kind of when I look at income statements, I always want comparisons. I normally like to do 3 years in a row. 2 years is not a trend, 3 years is. So typically, if I got a year over year over year, one, I would ask them for a 3 year. If not, I would just take these numbers, throw them in PDF and convert it to Excel, and then just have 3 years next to each other so I can see what's going on for 3 years. But 2 years is pretty good. Interest expense. We are buying stuff. I always question when a company makes 700,000, 800, million, million two, million five, and they're buying shit on loans. So that's an interest expense. Okay. So if interest rates are 10%, that means he's got $850,000 worth of loans outstanding. That is not a good sign for somebody that makes $700,000 a year. Could be fine, but it is a red flag for me to look into more. Okay. Financial fees. I don't know what that is. Is that somebody taking a credit card? Okay. And Henry, this is B2B, right?
Yeah, B2B.
Okay. under B2B situations, you should never be taking a credit card, ever, ever take a credit card in a B2B situation. If they want to use a credit card, you charge them for that. Okay, that is standard practice now. So that's an upside right there. Okay, I charge 4% if somebody wants to use a credit card for my flooring company, and have for about 7 or 8 years, and nobody ever bitches. It's standard practice on high purchases now, especially B2B. You do ACH or Venmos or whatever, or old school write a check. Okay, so that's an upside there. Just keep looking down. Computer expense and fees. Holy shit, $71,000. That's super expensive. I don't know what the hell they're doing there. Insurance, I would think this would be general liability, normal business insurance for 7 million in sales, 100 grand. That seems adequate. Big numbers. Facilities expense. I don't know what that is. It's not rent because rent's 2 items down. Facilities expense, is that new cubicles or new furniture or something like that? We'd probably ask what that is.
Some of it's refrigeration because they have some cold storage. And yeah,
Okay.
and, yeah,
Because
cold storage.
that could be a little bit of an upside. If they just bought a little bit of cold storage and ran it in here, that's probably a one-time expense, or once every 5 or 10 years. So that's a little bit of an upside to you, because that number probably should go back down to 30,000 next year.
Yep.
Okay. So that's a little bit of a bump in income this year. But that's pure speculation on my side. Rent, that seems fine. 10,000 a month for a distribution company. They have how many square feet do they got?
I don't know.
Okay. But that seems pretty decent for a distribution company because they probably have a pretty big warehouse. Okay. And then let's see what else we're looking at. Lease taxes, travel, truck expense. Interesting. I don't know what truck expense means, but it went down a shitload. That maybe could be from losing that one customer. And maybe that's here what you were talking about, Henry, that they were losing money, that they had so much, they were so far away. Maybe
Yeah.
I'm pure speculation here, but maybe this is one of the things they were talking about here, is just the travel expense was just stupid. So maybe they were able to sell 5 of their trucks. Maybe this is fuel expense here, fuel maintenance. I'm not sure, but we'll see. We'll see on the balance sheet what happened here. So there's your number. They made 848 last year and 569 before adjustments. You don't have an adjustment number, Henry? Owner's adjustments?
I don't have the full summary of it, but the adjusted EBITDA they're saying is like 700. Let's just say
Okay.
700.
And then here's depreciation. That's gonna be an owner's add back because that's pure accounting, non-cash items, right? So we're gonna add that back. So the 567 plus the 145 takes you to over 700, as Henry just alluded to. Okay. Any questions on the P&L there? So again, super important when you're looking at P&Ls. Again, I always like to throw them in three. Here's 23, here's 24, here's 25. What's going on? 3 years is definitely a trend. Which way they're going? Where's the expenses? Where's the outliers? Right? Just look at the big ones, and does it make sense? And then ask questions from there. Okay. All right. Now let me get back over here. All right, let's go balance sheet. All right, you guys see that? You guys see that?
Yep.
Yes.
Yeah.
Okay. I'm needing nods. Okay. All right. So they're making a shitload of money. They got a shitload of cash in the bank. That's good. Okay. We're looking balance sheet. I'm looking for verification. Okay. P&L is great and sexy. Balance sheet verifies what I just looked at on the P&L. And it shows all the skeletons in the closet. balance sheet is 50 times more important to look at than the P&L. Okay. So again, it just said it made $700,000 and I see a bunch of cash. Normally, if you're not making a bunch of money, you don't have a bunch of money sitting in your checking account. Okay. All right. Well, without going back to the P&L, Henry, this is not your question to answer. What was the revenue per year last year in the P&L? Anybody? Anybody remember? 7 million? Is that what we're going to go with? That's what I remember. Is that number about right, Henry?
7.5.
7.5. Okay, I'm looking at accounts receivable sitting at 556. So I'm doing $7.5 million divided by 12. That's $625,000 per month. Okay, so they have an accounts receivable of approximately 28 days. I'm just doing that in my head. Does everybody understand what I just did? They're averaging $625,000 in sales, and they have $556,000 outstanding. So when I sell something today, it's not collected on average for 28 days. Okay, everybody understand that? So if you ask me, without looking, they probably have payment terms for the customers probably between 20 and 30 days.
I didn't understand that. How did you figure that out?
Go back to that math.
Okay. All right. So 7.5 million in sales, and I divided it by 12 to see what their monthly sales are, which comes up to $625,000. And now I'm looking at their accounts receivable, which is $556,000, which is less than the 625. And if I'm just doing this in my head, that's about 28 days to get payments. DSO, days sales outstanding. Okay. Payment terms, et cetera. That's what we're looking at here, right? So if I sold something today, it's taking about 28 days to collect it. Okay. So if I would just guess that their payment terms with their customers are probably anywhere between 20 to 30 days. Right? I'm going to say 20 because they have some customers that aren't paying on time. That's what I'm going to say. Okay. Which is good. All that's good. Right. But we need to now take that into account on how much working capital we potentially need. Because when I take this company over, I may have a utility bill within 2 days, and I may have payroll 3 days later, and rent's due 4 days after that. And 5 days after that, my forklift just broke down, and I got a $50,000 new engine I got to buy for my forklift. Right. So I have money going out, and I got no money coming in for 28 days. Okay. So it's a plus minus, by the way. And by the way, we just finished a working capital calculator that should be downloaded into the community here in the next day or two, which is kind of goes through this sort of stuff, which helps you with the loan. So right here, if we bought this company for $4 million, I'm going to ask for 4.5 from a loan because I need another 500,000 of working capital. Thereabouts. I would need to spend 30, 45 minutes to figure out what that working capital calculator is. But that's a big one. Okay. All right. Let's talk about inventory now. So this gets really, 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 really confusing. When I buy a company, I'm buying it based off of a multiple of the net income. I don't give a shit how much inventory they have. I don't give a shit how many trucks they have. None of that matters to me. Sometimes when they're like, oh, well, the purchase price is 3 million plus inventory. Yeah, go screw yourself. If you didn't have that $400,000 of inventory, you wouldn't be in business. Okay. So how I negotiate inventory, it's a plus or minus. What is the 12-month average of inventory do you have? Okay, let's just make up a number. It's 400 grand. I'm going to write you a check for $61,000 because that is above what an historical norm is. Or I'll go the other way. Let's say the historic norm is 500. You're writing me a check for $39,000 at closing because your inventory is lower than what you normally have to operate that business. Okay. Under crazy circumstances, if this guy had $5 million worth of inventory, I would probably include some of that in the purchase price, but most likely I would not buy it because they're going to want a 4 multiple on it plus all the inventory. So then in essence, I'm buying it a 7 or an 8 multiple, which I don't even cash flow. So I just walk away from it. Okay. Same thing when, they got 40 pieces of rolling stock. And rolling stock is what I call trucks or their fleet or whatever, rolling stock. Oh, yeah. Well, I'm going to charge you for the rolling stock. Yeah, no, you're not. No, you're not. So if they get in those arguments with you, just move on. But again, I think the inventory and historic norms above and beyond that, plus and minus. Everybody understand that? Okay, because those two can get really confusing. But those numbers look good.
Yeah, it almost sounds like you can ignore it until you get much later in the stage. The inventory piece.
I wouldn't ignore the inventory. You're going to
Okay.
get screwed. So I want to be. You don't need to say anything about the AR, but on the inventory, I mean, what if you find out the historic norm's 400 and you got to be careful. They're going to sell all the inventory the last 30 days and they're going to buy shit. And you're going to show up and there's $127,000 worth of inventory. You got to write a check for $350 to get back to norm.
I see.
Believe me, you're the one that's going to get screwed there. Okay. All right. Furniture, fixtures, office computers. These are all balance sheet items. These are just what the costs are. Warehouse equipment, nothing changed. Freezer. So when we speculated on the P&L, they bought some new freezer shit. That number did not change. It stayed the same. Trucks and delivery vehicles. They didn't sell any of them. Remember, we speculated over there that their truck expense went way down, and we speculated that they sold 5 or 10 of the vehicles. Doesn't show up here. So that was all probably fuel and maintenance. So maybe they parked, maybe they had 20 trucks, and when they did away with that 20% business that they weren't profitable with, they might have 7 trucks just parked, not even doing anything. Okay. So those all numbers look good. Okay. All right. So let's learn about goodwill. Anybody know what goodwill is?
Money that's owed to you?
No. Goodwill. This is when I buy a company for $1 million. Okay. When you account for it. So let's say my flooring company, let's say we bought it for $1 million and it had $50,000 worth of assets. It had $20,000 worth of inventory and a forklift that was worth 30 grand. Okay. The other 950 is just hot air, blue sky, i.e. goodwill. So how I would actually account for that from a journal entry perspective, 950,000 goodwill, 20,000 of inventory, and 30,000 forklift. And then over on the other side, the liability would be $1 million loan, accounts payable, loan payable. Okay. That's how I would account for that. Okay. Goodwill is amortized because it is a soft asset. It is not a hard asset. A hard asset is depreciated, i.e. a truck, a forklift. That's a hard asset. That's depreciation. Soft assets, goodwill, software, patents, that sort of stuff. Copyrights. Those are soft assets, okay? Goodwill here is amortized over 15 years. Okay? So what's the accumulated amortization? It's right at half. Do you see that number? The goodwill's 2 million and the accumulated amortization is $1 million. So it's been amortized almost exactly in half. Does everybody see that? So if amortization is amortized, the goodwill is amortized over 15 years. This is in essence the purchase price this guy bought the company for. And it's almost halfway over. So he bought the company 7 or 8 years ago. I'm going to guess for $2.5 million. That's what I'm going to guess. I don't know if that's even close to being true. Henry, do you know anything about that? This company's been around 40 years. Did this guy buy it 7 or 8 years ago? I have no idea what that goodwill would be if he did not.
Yeah, your math is almost perfect. He bought it 8 years ago.
There you go. So I didn't even know that. So the balance sheet tells you everything historically about this business. I feel like I pulled that shit out of my ass, but it's there, right?
No, that's exactly
So
right.
and I'm
He
assuming that she bought it for $2.5 million. That's my guess. She put a small down payment down. There was some trucks or something like that. Maybe she bought it for 3. Okay. So anyway, I'm glad I didn't walk away with egg on my face after I said that. So that was good.
Question.
that was
How did you say
that was good. That
How
was
did you get
good.
to 2.5? You said they bought it for 2.5, but I see 2.1. How did you figure 2.5?
Because there probably were some assets they purchased. So that's just the difference of the purchase price, the hard assets, and whatever's left over is goodwill. So let's just say the purchase price was 2.5. Okay. They had $375,000 of trucks and inventory and stuff like that that they bought. And the difference was not any collateral, any assets is the difference. So it's just a plug number. Okay. And the fact that look at our assets up here right now is 689. And then you even have accounts receivable up here. So they have, let's just call it $1 million worth of assets now. Okay. I have a feeling they didn't have $1 million worth of assets 8 years ago. Right. We can make the assumption that they did. They had $800,000 worth of assets and the purchase price was $3 million. Right. Does everybody understand that math?
Yep.
Okay. So I'm assuming the purchase price was probably between 2.5 and 3 8 years ago. You should ask the broker on that and see if they'll give you an answer and then give me some feedback. Okay. What I do like to see, we're going to go down to accounts payable. When a company makes a shitload of money like this, we shouldn't have a whole bunch of accounts payable. That's super scary, right? So this is good that they're pretty low on accounts payable. So that is a good sign that they were actually making money. When somebody makes money and I see a big accounts payable number, that scares me. They're really not making any money or they're idiots and not taking advantage of early pay discounts. That could be 2 or 3% per month, which is a big number because you take that 2 or 3% and you multiply it by 12, which is really the interest rate. It's almost a 24 to 30% discount. You've got to take those. Okay. Everything else is good there. Here's some truck leases. So these are leases. You would take these leases over. A notes payable, these should be paid off by them. Okay. So you got to be careful when you're writing, you're making sure when you're doing your LOI that you're buying stuff fully unencumbered. You would take over any lease payments with your approval, but any notes would be paid off to zero at closing. Okay. So there's 2 big old Armstrong and Craig. I don't know who that is. Are those the names of the owners?
No. Nope. I don't
Okay.
know the name.
It's
I don't know who-
interesting. They're exactly 50-50, the same amount.
Yeah.
That's interesting.
Why do you say it's interesting?
Because how would you buy something that's the same price from 2 different people? And they weren't there the year before. Sometimes when I see a note payable like that, that's why I thought like, okay, Armstrong is one partner, Craig is another partner, and they just lent each other $98,000 out of the business and they're going to pay it back. I don't know what that's for. And they weren't there before. But either way, those should be zero. So those are a non-factor. Okay, equity. Here's a super important you understand what's going on with that equity. Okay. So I'm assuming the owner's name is Savage, I would think. Um, these are profit distributions. So when they make money, let's say the owner takes $150,000 salary, and then the rest of the money, the other 550 they made, they're going to do in profit distributions. Okay. All right. Retained earnings, current year. So this is current year right here where my mouse is. They made $686,000 this year. Is that right? No, that's prior year. Prior year. This is prior year. This is current year. So there's the net income right here for the previous year, 686. When they close the books out, it goes into retains earnings the next year. 686 plus 2.1 equals what? 2.78 right there. So this 2.1 is retained earnings over the last 8 years. That's how much money the company has made over the last 8 years. Okay. So what does that come to? Is that $300,000 a year divided by 8? So the company's made on average $262,000 a year over the previous 8 years. So this is the prior 7 years right here of earnings. I said 8. It's really 7. So that was a miscalculation on my part. So in essence, $300,000 a year. 3 times 7 is 21, right? Then we're going to add this year's income of 686, and that is going to equal next year's beginning retained earnings. Everybody understand how that works? Okay, so again, the balance sheet is a reflection of what's going on in the profit and loss statement. So this is where you can verify everything and make sure the company's running properly. Any questions on any of that stuff? That's confusing shit. So this would be a good video to go back and watch a second or third time.
So the distribution is 1. So is that what they took home? That's what they took home, right?
Well, above and beyond salaries, I don't know what their salaries are.
Okay.
And don't forget when we looked at that, there was $500,000 in cash in their checking account too. So that isn't all of the earnings, right? If I made $1 million, well, I don't have to distribute all of it, right? I can distribute half of it and leave the rest of it in cash inside of the checking account. So that's actually what was actually sent from the company to their personal savings account or checking account. That is not necessarily a reflection of the true income that they made. Okay. Questions there?
Paul, yeah. So while you're reviewing the balance sheet here, when's it appropriate to start going poking holes and probing questions to the broker?
This is what I like to do. I like to do some pre-due diligence. Okay, before I start spending any money, I come up with here just not a whole bunch of detail. Like you can ask, like, hey, what's up with this 98,609 for Armstrong and Craig? What's going on there? That's going to be a super easy question, right? The broker's not going to know, but it's like, hey, I got 5 or 6 questions that before I spend any money on due diligence, I just want to know some stuff going on, right? What is this? That's going to take 2 seconds to answer. So I normally like to ask 5 or 6 things that are kind of weird. So I think that is definitely weird. What were anything weird up here? No, you could ask hey, what are the payment terms for the customers?
Yeah, that's
just because I speculated it's 20 days. So I bet you it's 20 days. Hey, what's a normal inventory number? Can ask them that question real quick. You're not digging into a whole bunch of detail, right? The one customer they lost, looks like they got a good accounting system here. Can you give me a P&L real quick of just that one customer that you lost? So that'd be a 2024 because they weren't there in 2025. They should be able to print out a P&L, expenses, everything should be allocated to each of those jobs, right? At a minimum, you're going to see the very top half of it, right? So here, at least you're going to see this part up here. So from the 562, the sales, all the way down to the gross profit, they may not have wages and payroll taxes allocated to per customer. They probably don't, but they should have all of this stuff allocated per customer, right? And to verify that, oh yeah, they didn't make any money. So we're going to hopefully see that they did 2 million, 1.8, 1.6 million in sales. And then down here in gross profit, it's close to zero because that's what they just told us, right? Okay. So one email, 5 or 6 questions that they should be able to answer within an hour or two. And then if I feel comfortable, now I'm like, okay, those are good answers. Let's go. Let's proceed to the next stage. Let's go ahead and start working on the loan. Let's go ahead and find a due diligence team, et cetera, to go on to the next phase. All right.
Got it.
And then this was just kind of the little tiny summary that you put together. So there's revenue, EBITDA around 7 million. The margins for a wholesale company, 10%. Bottom line, I think that's fine. So I think you need to look at, this is super important to understand what you're buying and what the industry standards are. So like a flooring company, you should be taking, a lot of service companies, you should be taking 20% to the bottom line. Plumbing companies, HVAC, roofing, flooring, painting, you should be taking 20% to the bottom line. Wholesale, you should be taking 10% to the bottom line. It's kind of industry standards. And why I think this is super, super, super important. What did I look at today? Somebody showed me something and they presented it as a good idea and I presented it as a bad idea. They said the margins were 25% and industry standards were 10. What do you guys think about that? Let's just throw it out that it was a painting company and they're at 25% margins and I did analysis and painting companies make 10. Think that's good or bad?
It's a bad sign.
I think it's
Somebody's-
horribly bad. Horribly bad. If we all took calculus in high school or college, you regress to the mean, right? You're an outlier for only so long. Unless you got something proprietary or something that makes you so much better than the norm, that just scares the shit out of me. So they may have a great answer. Oh yeah, we make our own paint. I don't know. Maybe that's the answer. They're buying it for so cheap because they make it themselves. Instead of spending $100 a gallon, they're getting it 20 because they make it themselves. Right? Then that's a good answer. But charging more than other people, or using illegal workers that you're getting on the cheap, that's going to come back to bite you in the ass. Okay. All right, let's keep talking about this. Established 1975, absolutely love it. They've been around that long. Asking price, open to offers. I've talked to a couple, 2, 3, 4 of you guys in the last few days about, I hate this. I hate it. Because I feel like 75% of the time, this is going to be a bidding situation. And it's going to be a complete waste of your time. So, and we'll get into Henry's offer here in a second. He's got the LOI here. But let's just say he's offering 4 million, which he is, on this company here. So he's going to talk to the broker. Yeah, thanks for the offer. We're going to have this open until middle of May. We're getting as many offers, and we'll let you know if you made the first cut. And they get 50 offers in, and then they say bye to 45 of them, and they get on the phone with the other 5 that made the initial offers, and they're going to say, hey, you made it. You're one of the final 5. I'd sharpen your pencil. I'd raise your offer at least by 10% to be competitive. And now you're going to get in a bidding situation. Okay. So when you see that, the first thing I would do is I would call the broker and like, are you guys taking bids or what are you guys doing before you spend any time on this? And they're like, yeah, we're taking bids. And then ask them like, well, what does that look like? Here, I'm going to send you an offer today. Well, what's going to happen when I send you my offer? And if they say, oh yeah, well, we're going to compare it to a bunch of the other offers and we'll let you know if you made the final cut. And if they say that, just walk away. There's one idiot in every group that's going to overpay for a company. And if you in that situation and you bought a company, boy, you better be sweating because you just massively overpaid for a company. 100% guaranteed you overpaid for that company drastically, and you're going to have a hard time making your payments. Okay. But if you spend 2 or 3 hours on it, send it in, no big deal. But just proceed with caution, without a doubt. All right, let's pull up your LOI here. Any questions? Okay. All right. So this is LOI. This is the template that we have in the community. So you see, he took all the red stuff out, and the yellow is what he has changed. Well, I guess some stuff you're still missing out. You have to put buyer's name in and all this sort of stuff.
I took that
And you
stuff
probably
out.
left that out because you didn't want people to know who it was. Okay, perfect. You got October 1st. We talked about that. That's a little far out. Typically 90 days on due diligence. And what I like to have in there that it's automatically extended by you. Because what you don't want to do is when you get into an exclusivity period here that you're 90 days in and they've been taking offers and they just got an offer for $4.5 million and you're at 4 and your 90-day period just ended. They're going to kick you to the curb. Okay. So we got to make sure that our timelines are extended automatically by us, not by approval by both sides or anything like that. So we got to make sure we put that stuff in there.
So October 1st is too far out, you're saying? So that should be like 3 months from now, 90 days
3,
from now.
maybe 4. I mean, what's May? May, June, July, August, September. Yeah, that's 5.5 months out, right? You should be able to close a transaction within 3 months.
Even with the SBA?
Yeah.
Why do they have so much heartburn over the SBA? And like, because they are like, oh, if it's going to be SBA, it's going to be 6 months.
Who says that?
That's what one broker told me.
Well, okay. Mr. and Mrs. Broker, how else are people going to buy the business? You expect people to pay cash? Can't get a conventional note from a bank. There's no assets to any of this shit. So that's the only way to do it.
Okay, got it.
So does it take can it take 6 months? Yeah. If Wells Fargo, the bank, asks you for your last 3 tax returns and you take 2 weeks to send it to them, yeah, it's going to take 6 months. But when they send you a doc request and you turn it around in 4 hours, then it's definitely going to be 3 months. Right? So it's if everybody does things in a timely manner, it's definitely 3 months. Got it? All right, so let's get the purchase price here. So how we structured this, or how's Henry structuring this? We're saying it's a $4 million purchase, even though it's really $3 million. Okay, it's $4 million structured, $3 million to be paid at cash at closing. The other $1 million is a promissory note. We're doing an earnout here, are we not?
Yeah, we're going to do earnout. That should say
Okay,
earnout.
that isn't how it's written, so we got to rewrite that.
Yeah, this is an older version. Sorry, I forgot to put earnout.
Oh, that's okay. All right, so we'll just talk to it. So what we're doing here, he's doing an earnout. Okay, so these guys want 4 million. Is that right?
Yeah, they want 4 million, and then we want to find a way to get, like, basically have the earnout, or have the earnout get to that $1 million gap. So basically 3 million cash at close, ideally, and then 1 million earnout.
And an
And
earnout.
TBD.
So we're talking about over 3 years. Let's just say that the foundation is $700,000 in earnings. Okay. If they make $800,000 next year, we're going to give them another 300 grand. We're going to turn that into a note, a 10-year note, $300,000 payable over 10 years. And then we're going to go to the next year, still with that foundation of 700 grand. Let's say they make 900,000 the next year. Man, I may give them 600 grand. Right? Typically, I like to do an earn out over 2 or 3 or maybe 4 years. And then let's say the next year after that, they revert back to $700,000. So the earn out is going to be 0. So we're going to give them the opportunity of what happens over the next 3 years. We're potentially going to give them another $1 million that we're going to turn into individual seller notes for each year's results. Does everybody understand that? Okay. This is a good way to bridge a difference. He's at 3 million and they're at 4 million, right? Oh man, this company's awesome. We're not doing any marketing and we got a bunch of people calling us. We get the best product. Okay, well, great. Then we should be able to do an earn out, but I can't buy based off of what you think is great. And if you think this is so great, help me get there. Come in and be a part-time salesperson. Stay on for 3 years. Okay. And I know they can't stay on for a year for the SBA. You can do something underneath the table that the SBA doesn't need to know about and be a part time salesperson and to help them entice them to get to those additional revenue targets. And they'll get that other $1 million. So the earnout is a good bridge. Okay. If you can't come up and they won't come down anymore, then we do an earnout to bridge that gap. That we understand the earnout.
What's too long for earnout?
Too long of a period for the calculation or too far of the note
Too
once
far.
earned?
Like if it's 1 million, can you do it over? You said 3 years. Can you do it over 5 years? Can you do it over 8
Yeah, I
years?
wouldn't do it 5. No way. I'm not involved in the company in 5 years, and there's too much bad stuff that can happen in 5 years. It could be a recession or new pandemic or anything like that. No. 2, I like 3, 2 to 3 years. I think 3 is fair. But make the targets out there, reachable, but hard to get to at the same time. Don't just give them the earn out. And this is a good deal. Make 700 grand for 3 million. Been around a long time. You're buying a little bit over a 4 cap, right? 4.2. I do that number right? 4.2 multiple
Can
for a
you?
distribution company that's got inventory and a lot of rolling stock. Been around 50 years. I think normally I don't like to go over 4, but I would go over 4 this one.
Could you pull up the Searcher OS calculator? Can we look at the calculator together? You have it in your second tab, Paul.
Oh man. Let's see. I don't know if I'm logged in. Can I just pull up my calculator?
Yeah, that's fine too.
Can we use this one?
Sure.
Is that fine? What do you want me to put in?
So the asking
3?
price. Do we put in 3 or do we put in 4?
I don't know where you're going.
I was gonna see. I just want to show everyone like what what my earnings would look like. What?
Well, this is what you're committing to. So let's put
Yeah.
this in first. Annual revenue 7.5, right? There, Nick. Nick, by the way, you're going to get this. By the way, Nick, we got your info already in there from today. All right. So here it is. I said 4.2, 4.29, cash flow multiple, revenue multiple, profit margins, total acquisition cost. Remember, we're rolling in this SBA guarantee fee, right? Everybody understand that? So it's approximately 3%. 2 to 3%. So that's going to be added to your loan. So your acquisition cost is really 3073. You're putting down 300 grand. It's really a little bit more than that because you got to pay 10% of the 73 grand too. So there's your loan amount, 2.7 monthly payment, annual debt service coverage ratio. I don't like anything under 1.75. Okay, you're starting to get real skinny, but again, I'm fine with this one at a 4.2 and a 1.64. SBA is going to approve anything over 1.25. Okay, I don't know why. That's super skinny. So there you are. Cash on cash, 300 grand. Where's your take home? Oh, there's your take home, 273. So you're after debt, after all expenses and after all debt payments, you're making $273,000. It calculates a break-even revenue. This is really cool. So your sales can go from 7.5 to 4.5. You won't make a penny, but you'll pay your debt service still. Okay. That's a pretty big decrease in sales and you're still afloat. So that's really good. Okay. You want to see where we are if we're at 4?
Yeah.
Let's just change this to 4. And we're going to assume because we paid the $1 million, I'm going to assume our SDE is 825. Because if it's not 825, they're not getting any of this stuff. Okay.
So maybe we should talk about this because this is unclear
Yep.
to me right now. Can you scroll up and go back to the net cash flow? Okay, so when it was 3, when we put the asking price at 3, we said the net cash flow was going to be 273K, right?
Yep.
Now, what I don't understand is with the earnout can't come out of the net cash flow because it would be way too much, right? If it's 1 million over 3 years, I basically have no cash flow to pay for that. So I'm trying to understand
No,
where
you
does
will. You will. So again, it's multiple notes. So year 1, you have to make $800,000. You don't pay them a penny more. If they make $780,000, they don't earn the earnout. It's all or none. Okay. If they made the $800,000, you just made an extra 100 grand. You now have a new $300,000 note for 10 years going forward. And it's a seller note. You're not going to be paying 9.25%. You're probably going to be paying 6. Okay. All seller notes should be market value from a retail perspective. If I gave them 100 grand, what are they going to do with it? Oh, they're going to put it in a 30-year treasury earning 5%, 4%, whatever it is now. So I always pay what they can go get in the market themselves. So you're gonna be paying at 6%.
right?
Okay.
So okay,
We can we can redo it that way. Let me calculate it here. So let's just do it here. So in essence, the purchase price was $3.3 million, right? 3 plus the 300 it made. Okay. So how much did it make? It made 800 grand. Right? Because it had to get to $800,000 to incur an additional $3 million or another $300,000. So that makes sense. Now you're making more money. 331. You bought a company that in essence did $800,000 and you bought it for $3.3 million. So that's a good deal. You paid on the additional $300,000, you paid a 3x. You bought the other money at a 4.2x.
oh, okay. So let me make sure I
Makes
understand what
sense?
you're saying.
So the earnouts are going to be cheaper from a multiple perspective.
Okay, so I think I get it. So what you're saying is, all right, so that first year, that extra 300K, that they're only going to get that if we reach that new
The $800,000 target.
The $800,000 target. Okay. And then that's when they get that money. And do we just hold it? Do we just hold it in escrow, or do we just hold it in our account until
It's just
then, or
hold what?
300? The
No, it's
extra
a
three.
new loan. So you're going to start making payments on month 13 of that 300 grand. It's a 10-year loan.
Got it. Okay.
Okay. So what I'd like to do, I don't like a lot of detail on letter of intent. It's a $4 million purchase price, 3 million paid at closing. The other $1 million will be earned in an earnout to be negotiated at a later date. Okay. You and the seller can get together and figure out what that looks like. Okay. Do not go into detail. Oh, year one, it's going to be to $800,000 and a 6.25% rate paid over 10 years. You start going all sorts of detail like that, they're just going to vomit all over the place. Then you sit and negotiate on what the earnout looks like for 4 weeks. Get it under LOI and negotiate it later. Make sense? This is good stuff, guys. You guys can bring any of your deals like this. Send it to me. Make sure everything's redacted, and then we'll go over yours. You guys, anybody else got any input? You guys think Nick or Henry should move forward with this? You guys like it? Yep. Okay. I'm gonna stop sharing here. Get back here. Henry, good stuff.
Thanks. So it sounds like everyone thinks I should
Yeah.
buy it. Is that right?
I
Yeah.
fell off for a little bit there. It sounds like an established company that's making cash. So as long as you get it for the right price,
For the 3, yeah.
yeah,
Exactly.
What do other folks think? What do other folks think?
ask. But yeah, it seems like an opportunity unless it's going to get dragged out for a pricing game.
Jennifer, Jason, anybody, Jan?
Yeah,
Anybody?
I just didn't think you could do earnouts when you did an SBA loan. I thought earnouts were prohibited.
What's prohibited?
Earnout with an SBA loan.
No, you can do an earnout. Just the earnout itself won't be an SBA note. The earnout will be a seller finance.
Okay.
Yep. Yeah, I don't see that'd be a problem. Banks can, the SBA has rules, and then the banks themselves can come up with their own rules. So is there a bank that won't take an earnout? Yeah, possibly. I haven't come across one, but they can come up with all their own stuff themselves.
Yep.
Right. SBA will lend against certain companies, but some banks won't. Like the SBA will lend on oil and gas, but there's a bunch of banks that won't touch oil and gas companies because they're too volatile. But the SBA is fine with it.
Yeah.
Right. Yeah. Cool. Well, this is
I'm
good.
interested in hearing how it goes if Henry, if you end up in a bidding war on that, and how that all gets handled. So
Yeah.
good luck.
And Henry, we all want 1% of the deal for being your consultants here too. So that was in the fine print, by the way. So
one thing I think is interesting that might be useful to the group is they mentioned that some strategics, maybe, I don't know if you guys want to spend time on this, but strategics are offering way more than the 4. And what's interesting about the dynamics is some are offering a lot lower. I think people who don't know like how to deal with the earnouts are at a disadvantage. But I think there's also, so like people who don't know how to do earnouts, they're like, oh, this is only really worth 2.1 or 2.5. And that's going to piss off the seller. But what I think is interesting also on the other end of that is you have strategics offering like 5.5, right? And then people don't understand and this is something Paul shared with me, is the strategics are going to offer way more, but the owner's take home is going to be substantially less than
Yeah,
what you
let me talk about that strategic. So he's talking like a PE company. Okay. When you own a business and you're ready to sell in 5 years, never ever sell to a venture capital PE. You will get screwed. Okay. So what they're going to do is Henry just said a strategic or a PE is offering $6 million. And the seller's like, ah, sweet. They're going to give you $2 million up front on day one, and you won't get the other four. 100% guaranteed. You will not get the other four. Right? If part of the contract is you're supposed to wake up at 6 o'clock every single day for 5 straight years, and if you wake up at 6:01 one day, you don't get the other $4 million. And even if you did everything right, they're going to take you to court forever and not pay you the other $4 million. Never, ever sell to a PE venture capital company. Never. Unless you're okay with not getting the back end, because you won't. I promise you. So I'm looking at a deal right now that's a $12.5 million purchase, and they will not entertain venture capital PE. It's got to be an individual because they know that. Most people don't. So PE and venture capitals, they look at 300 deals, 300 deals for every one they buy.
I have
So
a
you're the one or
question.
you the 300. So they're going to screw around with your time. Yes, ma'am.
On the earnouts. So I am, I'm assuming, I'm guessing, you have to have a good relationship with this seller in order to be willing to keep them on for any extended period of time for an earnout situation.
Well, two
Um,
things. Yes, I'm going to answer it quick, and then we're going to get off.
okay,
But we can talk about
okay,
earnouts more later.
okay.
This is why your relationship and conversations with the seller is so important, that you have to become friends with them, right? And they have to become comfortable with you. Like, no, I think Paul's an idiot. There's no way I'm going to do an earnout. He's going to ruin my company. So no, I'm not doing that. So you got to make sure you're presenting yourself in a certain fashion that they become comfortable that you can run, not just run, but operate well and perform well, and maybe even overperform and grow the company before I would agree to an earnout with anybody, right? And same thing, right? So if you work out a deal for this seller to stay on to help you get there, well, do you think that person can actually help you get there as a part-time salesperson? If you don't, then that's not a good situation either, right? So there has to be big time trust factor on earnout. Yep, and we can keep talking about earnouts going forward. It is kind of confusing, but we can start bringing that up more and more. It's good stuff. Bring me deals. If you guys got something for us to look at,
Yeah,
it's good to analyze them here for everybody to look at.
I think a couple things that would be helpful is like what was just brought up, and then the working capital. How does that fit inside the loan? Things like that.
Yeah,
Ways to do notes. I think all that stuff could be potentially really helpful for the group, because when I read like not mythology, but like the other deals, a lot of times, people are just, especially first time deals, you're just like not sure or not comfortable like doling over lots of cash, but finding ways to make those deals happen through seller financing in creative ways, I think can really be an advantage if you understand it and then you understand how it works with the mechanics of the loan. I think that's a huge advantage.
yeah.
Because
Okay.
Paul, you're comfortable and fluent with it, but people like me are just like, okay, I see that these big numbers and I'm just like, well, fuck, I'm not gonna, I'm not
Yeah.
comfortable with it.
You
But
guys are already well above and beyond 95% of the people that are looking at deals. So I mean, just coming to these every single week, just what we learned tonight. I mean, if this is your first thing you've ever come to, you already know more than 90% of the people looking at deals just off of this one phone call. So Okay, cool. That's it. I guess we'll talk on Wednesday.
Yep. Good luck,
Thanks.
Henry.
See you guys.
Thank you.
Bye.